The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.
And joining us now here as we continue our coverage at the agmarket.net Farming for Profit Not Price Conference in Nashville, Tennessee. Very pleased to sit down and have a conversation with Dave Hightower from the Hightower Report. And Dave, it is great to see you again, sir. We got to chat last year. It's always good to have a conversation. Thanks for joining us today.
Well, I wish this had as good outlook as we had last year. So
that is a good point. You know, I've talked to a lot of folks here at the conference and really the last few weeks, and it feels like a lot of folks have just gotten very bearish in this market, right. And that's where the sentiment is. And it's thinking about putting a crop in this year. A lot of these guys and gals who are here at this conference, they're worried about cost of inputs and the price in the market and everything, and just not the greatest feeling, I guess, so to speak. But let's talk about that. Share what you're looking to tell folks here today. I mean, I know a lot of people are focused on the bottom and where that bottom's going to be, but you mentioned to me you're kind of more like, okay, looking at what's going to signal that bottom. Talk about that a little bit, Dave.
Well, I would throw out an idea to the corn and soybean growers at their annual meetings, and that would be to take a page out of the book of OPEC, in which the farmers can get long this market in futures and then have a discussion at their annual meeting that they're going to hold back 15% of the acreage. Because that's really what happens in the oil market, is that OPEC comes up with ways to make the price go higher. But without that, there are several things. We were very unfortunate in terms of the U.S. farmer that production out of Ukraine was not more damaged and longer-term damaged. But there is still their assets, their funding, their seed, their fertilizer, the diesel, all that's still very difficult to come by. And I was at a conference in Bulgaria with Russians and Ukrainians in the same room. And the Ukrainians were very upbeat. They talked, look, this is our situation, this is our reality, and we have to figure out a way to live through it. But, you know, there's going to be a little bit of issue there. They now have ways to get the supply out besides the Black Sea. Mm-hmm. Of course, it's not optimal. So that's one flashpoint that I could see. Unfortunately, another flashpoint is China, which is showing real problems. And I wonder if the Chinese President Xi is going to make it through this even. But, you know, when China catches a cold, or when China sneezes, the rest of the world catches a cold, and particularly in commodities and particularly in the grain markets. So what I would be looking at when we come in for a bottom, everyone talks El Nino, okay? Mm-hmm. And I've been doing this 40 years, and I've yet to really see a noted impact from El Nino and even La Nina on the U.S. grown commodities. Where you want to look is in Southeast Asia. You want to look in the palm oil area. You want to look at the soft commodities like cocoa and sugar and coffee. And we've already seen the coffee, sugar, cocoa markets were one of the best performers last year because the market saw this adverse weather, and it did hit crops. It hit coffee crops in Vietnam. And so it can also have a little bit of an impact on South America. But I think that's one thing to watch because energy, palm oil, very significant driving force for corn and soybeans. Mm-hmm. And we've seen the help from the ethanol industry and the biodiesel area. And, palm production is 6, 7, or 8 times, depending on what year, the size of all U.S. production. Mm-hmm. And if you combine all the edible oils besides palm oil, they are a fraction. So if you have a problem in the palm production, it could be an exponential impact on soybean oil, then the entire complex shifts back up. So I'll be watching that very closely. And also, it's the oil market.
Sure,
we could see a 40-cent rally in corn. I remember farmers telling me the markets aren't trading fundamentals. And that was because we went through a bad period where it was so bearish and we were overproducing that the markets were just going down off everything. But now it may not trade fundamentals because it may leap higher without really changing the supply and demand balance sheets in the U.S. So oil, Southeast Asia, and I think China's going to make it through. They're still a huge consumer of commodities, and that's going to happen. And we are getting some rain in the wheat areas that have kind of got us away from that issue. But I would say this: when you're hedging, you don't know what's going to happen. And when you look at where prices are, we're in the lower 25% of the market, and we have record spec and fund shorts in the marketplace. So that doesn't mean that additional specs and funds that have never traded they could come in. But now we're at a point where most of the people that characteristically trade are short the market. And so that should slow the downside. But what happens is when that fulcrum changes, you're going to have not maybe 100,000, but certainly tens of thousands of contracts that are going to be stopped out. And so it's not going to be a rally that maybe maintains. But I'm going to have some strategies today to position them for that, because I think like this conference, farming for profit, instead of looking at that price of corn and soybeans and putting a marketing target on it, I think strategy over opinion is what helps people survive.
Are you worried about the conflict in the Middle East adding volatility, especially in that oil market here in the short term, potentially, Dave?
Absolutely. I mean, we have to realize that even confronted with an overwhelming force, that the Yemeni pirates, they've shown no desire to back down. They've even attacked battleships. But the Iranians are also along that line, in which they're very religious. They're theocracy, so the religion plays a huge role in it. And so there could be if there's an exchange between the U.S. and Iran, and if we put some kind of armaments on the ground in Iran, then you're going to see you'll see a $30-$40 rally in crude oil. And if you look at a chart of corn and crude oil and soybeans, they're virtually tracking each other. So you have to be prepared for that. Yeah. And whether that means you're going to sell, maybe you replace it with a call option right now when we're cheap, knowing that long call gives you the confidence to sell your cash, and you still have a toe in the water going forward. You don't have to meet a particular yield or a production level either, as long as you know what to sell in cash.
I want to ask you, circling back to China and your comments about, China sneezes, world gets a cold. I know we had the Evergrande issues here just a couple of weeks ago. That was a big headline in the market, and there's been a lot of talk about the Chinese economy. Do you feel like that Evergrande issue is maybe the start of something here potentially with this Chinese economy situation right now?
Well, it's certainly a symptom of what's been going on already.
Yeah.
And, they've thrown a lot of money at it. And the difference between an open financial market and what China has is that we're not going to know the really bad stuff. And they have the ability to throw the money. They've got $13 trillion in cash kind of securities, even ours, and they've been liquidating our treasuries for 11 months. So I think they can pretty much, it's easier for them to stop a financial market crisis than it is a jobs crisis or what have you.
A lot of farmers here and around the country are worried about just the interest rate environment here in the U.S. and that effect on everything from operating loans to buying equipment to the prices in the markets and commodity inflation, deflation, et cetera. There's been talk that 2-3 rate cuts might be May now before we see a rate cut. Your thoughts on the overall inflation state here with the Fed right now and how that's playing into the ag side?
I've been around a long time, and the younger people have never seen what normal interest rates are.
Yes.
And that's another thing I'm going to talk about today, that the cost of U.S. government borrowing has gone up, and we really can't afford it now. And if I needed to borrow money, if I didn't need to borrow money and I was young, I'd probably borrow it anyway, because this may be the lowest interest rates that you'll get for the rest of your life. That would be my forecast. And the non-farm payrolls were strong. This economy continues to show resiliency. Once we get off the Fed's this, the Fed's that, I think we're going to be all right. So I would be very afraid. I would lock in my operating if I was going to buy some land, if I was going to buy a house, if I was going to buy a car, I wouldn't because they're too expensive. So anyway, that's my view.
Yeah. Dave, I got plenty out of a 10-minute conversation with you, and I do appreciate the time and the knowledge and the insight. And thank you for joining us here in Nashville. We'll have to continue the conversation again in the future, Dave. Thanks so much.
Well, I wish the producers luck. They may need it this year, but you know what? We don't know anything that looks like it's positive now, but it's too negative. How's that?
Yeah, I agree. Dave Hightower with the Hightower Report. Dave, thanks so much for joining me. Really appreciate the time.